Let's talk about delta. Delta is probably the best known out of all the option Greeks. And the reason is when you first get into options, most people are getting into options because they want a form of leverage that you don't get with stock. So let's, for example, talk about trading the SPY, which is essentially trading the US stock market. Now, if you wanted to buy the SPY outright, it's going to be expensive. It's about $200 a share. But with options, you can choose an option that's cheap enough for you, anywhere from $50 to thousands of dollars. Now, if you buy one share of the S&P and it goes up $1, you've earned $1. Options aren't equal to stock because stock and options differ in what's called delta. I'm going to show you that right now. Now, how do you find the delta of a stock option? Well, when you're looking at stock options in your brokerage, you should have the deltas in the Greek section. Alternatively, you could just find them online. You can type in NASDAQ SPY option chains, and you will be able to look at the deltas of each option. Now, delta can be explained in one of two ways. They're actually equivalent, but you're always going to find that delta is going to be between 0 and 1. Now, once you get into this site, all you have to do is click on Greeks, wait. I don't know why. Certainly shouldn't have to wait. Alright, so there you go. You got the Greeks for all these different options. So here's a February. Well, that's expired. These are all expired. Let's go out to May. Wait again. It's NASDAQ's fault, not mine. And you'll get a list of all the Greeks with all the options. So here's the May option with the strike price 174. And you see the delta is almost 1. So it almost mimics the stock. But down here, when you get more out of the money with the strike price, when you get closer to the real value of the stock, the deltas converge around 50. Okay, now I'm going to explain what that means in a second. But let's go back to this example first. If the SPY goes up $1 and you're holding one share of the SPY, you get $1. So SPY goes up to 194.20, you can sell that and you've earned $1. With these options, let's say you're playing a call, so you're going to be long. This is a service I use to check certain things about options. So I'm going to show you the Greeks in here because we can arrange them in a much better order. So we're looking at the SPY and we're looking at long options on the SPY. I'm going to click on Greeks and I'm just going to arrange them by delta. And we see that one of the popular options is this with a delta of 90. Now it's expensive. This amount equates to $1,305. So you would have to pay $1,305, but you're mimicking 100 shares of the SPY. However, because the delta is not 100, you're not going to get $100 every time the stock goes up $1. Instead, you're going to get $90.99. Now, the advantage of this program is you can arrange it by delta versus cost, and that'll give you a good idea if you're long on delta, if that's your goal. And for most people who first get into stock options, their goal is to maximize delta versus cost, then you probably want to buy the option corresponding to this ratio. But as you'll learn later in the series, delta is not the only thing you should be looking at. But check this out. It's only $5. So you've got a March call contract that's only $5, and your delta, well, it's only 2. So it's a high risk, high reward in terms of percentages, and it's a low risk, low reward in terms of absolute dollar value strategy. So you spend $5 to get this call option, and if the stock moves up by $1, you get $2. Doesn't that sound better than paying $193 for a possible $1 change? It sounds almost too good to be true, and in fact, it is. But we could talk about that when we talk about theta. All right. It's not too good to be true. It's just you're gonna have to theta hedge, and you'll learn about that when we talk about theta. All right. So the idea here is one explanation for delta is the amount of money you can expect to earn when the stock, the underlying, in this case it's SPY, moves up $1 in value. So you buy a stock option, which is just a contract, it's just a piece of paper, and attached to that piece of paper has a delta, and the delta will tell you how much you can expect to make for every $1 gain in the underlying. So the SPY goes up 194.20, and now you've made $2.30 on an option that you only spent $5 on. All right, so you've almost doubled your profit. That's delta for call options. Now delta for put options is actually going to be a negative value because you want the stock to go down. So let's say you short the SPY, you outright short it, that exposes you to unlimited risk, theoretically. So the next day, if the SPY jumps to $200, well, you've lost a bit of money if you shorted a lot of stock. For a put option, you have limited risk because your maximum risk is simply what you paid for the put option. Now again, we can go to the Greeks, we can arrange it by delta versus cost, and we want to switch to the most, okay, so this is the best in this case for this ratio, and here we get a -8 delta. Alright, so what that means is if you buy this put option, it's going to cost you $51, and every time SPY moves down $1, you gain $8. That's what the negative delta means. Now overall, deltas are additive. So let's pick a pretty easy example, and let's say you buy 4 contracts of this option. So you've spent $20, you bought 4 of these, and the SPY goes up $1. Now because you have 4 of them, and because deltas are additive, you add delta together 4 times. In other words, you multiply by 4, and you get a delta of a little over $8. I'm just going to say it's $8 because I want to use this in a second example. All right, so let's just round down and say it's going to be $8. Now what that means is the SPY goes up 1, you earn $8 on your $20 investment. Now because deltas are additive, when you add a delta of a call option and a delta of a put option, you'll get actually subtraction because you're adding a negative number, right? So let's say you buy 4 of these SPYs and you get a delta of around 8, and then you buy one of these puts and now you have a delta of -8. Now you add those two together and your delta is 0. In other words, you're delta neutral. Now the first question you should probably be asking is, why would you ever want to do that? And I will talk about that more when we talk about another Greek by the name of Vega. But for now, just imagine the idea of being delta neutral. If it's 0, if your total position is 4 of these SPY calls and 1 of these SPY puts, your total position is delta 0, neutral. So no matter which way the SPY goes, you make $0 from delta. This 0 delta position makes you no money when the stock moves up and down. Okay. Now, what about the stock itself? Stock's delta is 100. Stock's delta is always 100. It's 100%. So if the stock moves up 1, you gain 1. It's always going to be just like that. Now, if you've listened to my interviews or if you've watched any of my videos on stock options, you probably heard me say once or twice that I don't believe there's any real reason to buy stock unless you're going for dividends. If you're buying stock because you think the stock's going to move in one direction, in my opinion, it's always better to buy options. Now, some people might say that's wrong because a stock has 100 delta. You get 100% of the movement in your profits. But options don't have 100 delta. The closest you can get, it's close, but it's not 100 delta. And if you want to go this high, it's going to cost you a lot of money. Well, what did we just learn about delta? We learned that deltas add, right? If deltas add, couldn't you just do this? Couldn't you just find a 50 call? Okay, let's talk about this call option. The delta is 50, right? Now, if you buy an option, you're long on delta. What if you sell an option? You're short on delta. So the addition becomes subtraction. So here's what you do. You buy this May call option, you get 50 delta, and then you sell this negative 50 put option, say this one. You sell this one. Now how much is your delta? Well, 50 minus negative 50 is 100. Now your delta is 100, and you get exactly as much money as you would holding 100 shares of the stock. But if you hold 100 shares of the stock, how much does it cost you if you buy stock? Well, it's going to cost you about $20,000 to buy 100 shares of the SPY. How much will it cost you if you buy this call option and you sell this put option? Well, if you buy this call option, it's going to cost you $623. And if you sell this put option, you're going to earn $465. In other words, it's only going to cost you about $100 to get 100 delta. But in this case, it would cost you $20,000 to get 100 delta. What I just said is what's called a synthetic position in options. A synthetic position mimics stock, but you do it with options, and you don't have to pay that much. You only pay a very small fraction of what you would pay if you hold the stock, and in some cases you get money for opening the position. You get it for free. For example, look at this one. See, this one's 50, right? You're going to pay $341 to buy that option, and then you're going to sell this option. You've made $100 and something to have what equates to 100 shares of the SPY. That's the power of options. Now granted, if you do that, your risk is going to be larger, because if the stock moves against you, you'll lose more money than if you were just holding on to the 50 delta call. Because when you short or when you sell or write a put option, you have more risk. But still, your risk is the exact same as the risk of holding the stock. So honestly, I don't see any reason to ever buy growth stock outright. It's unless they don't trade options, of course, or if the options just aren't popular. In that case, for example, if I click on this, you'll see how popular this option is. The open interest is 1,265, so that's pretty popular, and you can see that the bid and ask is pretty tight. So this is a good option, but you won't always see that. Some stocks are not popular to trade on, and therefore you won't see them having these close bid and ask spreads and the open interest that you see on popular ETFs and stocks like the SPY. But if you do have something that's popular, there's really no reason to outright buy it when you can get 100 delta from creative option buying and selling. The reason people don't do it is they don't know about it. They really don't know about it. And some people, I don't think a lot of people, but some people will hold the SPY because there's a small dividend. But overall, that's the basics of delta. I said there are two ways to explain it. I just explained it in probably the most intuitive way. The other way to define delta is the probability that this call will be in the money by the expiration date. So here is May as the expiration date. The delta is 91. So what we know is that the stock SPY has a 91% probability of being over $181 by May 2016. And that makes pretty clear sense because it's above this. But as everyone has different mindsets, I, for example, believe that the SPY will not be over that value, over 181 by May. I think the SPY is going to crash. So for me, this would be a stupid buy, and I would be more apt to selling it than buying it, especially if I can make $1,000 on my prediction. But overall, I think you understand the delta. So just to review, there are two ways to explain delta. One is the probability, and ignore the negatives if you're playing puts. But one is the probability that the stock option will be in the money. In other words, the stock will be over 181 by the expiration date. In this case, is May. The other way of explaining delta is how much you can expect to make from that call option every time the underlying, which is SPY in this case, moves up $1. So if you are using options for directional trades, you generally want to look at delta and gamma, which we'll talk about later in a different video. But you generally want to look at delta and determine what your ideal delta would be based on cost, and maybe do a quick calculation to find something good. In this case, this is a pretty good ratio, but these way out of the money call options are not really that great because they have a high theta attached to them, and we'll explain that later. Also, this one's not very popular. You can see the open interest is low. And finally, if you go back to that second definition of delta, the probability of this being in the money or this being worth money by the third week of March, well, it's only 2%. So there's a 2% chance that this is going to be profitable in the end. Of course, if you're playing directional trade and you're swing trading, all you care about is delta. You want the stock to move up and then you sell. So you're not going to hold it all the way to March. Let it move up, sell, take your delta profit, and you reinvest. So that's the idea. That is delta. And don't forget about synthetic positions. You can always add deltas and figure out a way to make 100 delta with options, and thereby mimic holding 100 shares of the stock, sometimes at a immediate profit instead of a very expensive cost. If you like this video, please click like. That's what the like button is for. Subscribe, and I will make more videos. And also, in the comment section below, please tell me what types of videos you'd like. Give me a topic and I'll make it for you.